I might just jump through a couple of questions and show you additional resources. So I know, Sue, you were asking about what's the optimum amount to salary sacrifice. There is a calculator on the Christian Super website. So if you go to christiansuper.com.au/calculator, there's a calculator that helps you plan for your retirement. That might relate to somebody else's questions about how much you need for retirement as well. That's a good place to refer you to. But that calculator sort of helps you, gives you an idea of what you need for retirement, how long your retirement assets will last, that sort of thing. There's that 1300 number to ask about a question somebody had earlier. And for further information, you can log on to my website. So I've got, and there's a contact us. You can just click contact us, and I'll sends an email through to me, and I'll give you a call or shoot you through an email to start the process going. You can also call this 1300 number. You can do that to book an initial consultation, or I've started podcasts, a weekly podcast where I answer a range of questions. If you wanted to encourage me in that, then you could leave a question on that. So 1300 275 428. That's 1300 ASK GAV. And basically it's just a voicemail. Leave a voicemail question and I'll answer it on a podcast in the future. And you can access that podcast either via my website or iTunes. And then there are further webinars. So there's 4 more webinars for the year. And you can access those or register for those using that link there as well. So I'll just continue to answer your questions and run through the remaining questions that people left on registration. I got a question from Roger, and then I might open the line up to you, Jim, to ask your question verbally if you like. If you are over 65 and receive inheritance money, is it advantageous to add that to your super fund, or is that a costly process? Great question, Roger. I often run into people who are in their 70s or later and no longer working, and they've got a significant amount of money because they might have received an inheritance later on in life that they couldn't get into the super environment. And they're quite frustrated because they're paying a certain amount of tax and they can't, there's not many strategies to reduce it. So generally the focus around that 65 years of age is to try and get the inheritances or other money into that tax-effective superannuation environment, because it's not only tax-effective, as in at 0% tax rate, it's any money you draw from it is tax-free, but also if you are eligible for an age pension, it actually is really good from an income test perspective. It actually works quite well to have your money in super. Yeah, it is ideal if you can get the money into super. If you can't satisfy the work test, if you're over 65, that is working 40 hours within 30 days, you can't get your money into super. So depends on whether you can satisfy the work test as to whether you can get it into super or not. So hopefully you can. It's not a costly process at all. It's if you just got the money there and you need to contribute to super, there's no tax to pay. There's nothing. There's no contributions tax. It's very simple and not costly. But the trick is satisfying that work test. Now, Jim, I'll try and open the lines. Are you there, Jim?
Yes, I am, Gavin. Can you hear me okay?
Yes, I can. Yeah, loud and clear.
Right. There was 2 questions. One, I've resubmitted the question that I posted on the webinar site.
Yes.
But the other question was, the first question is, how many members or accounts are there in Christian Super pension phase?
Good question. That's not an answer I know, to tell you the truth. I know there's 19,000 members in Christian Super altogether. That includes Christian Super. But I'm not exactly sure about how many are in pension phase. But I can find that out for you and get back to you if you like.
I'd appreciate that.
Yeah.
Do you want me to go ahead with the other question, or do you have it on the email?
I've got it here, but if you ask it, that's a more fluid way to do it. Yeah.
All right. The question is, for a couple like ourselves, I'm 72, my wife is 70. We have an investment property that we wish to liquidate and put the proceeds into Christian Super. We will meet and continue to meet the work test. There is a 75-year age limit. on opening an account. But what is the best time to do that? We've certainly been thankful we had the investment property rather than anything in super with the recent global financial crisis. Any comments about what's the best thing to do?
Yeah, it's a good question, and great that you actually satisfy the work test to be able to get the money into super. And depending on what your work circumstances are, it should be possible to, for example, sell the investment property. It's likely to have triggered a gain. You can then make contributions to super to potentially. Now you have to check all your details here, but you could potentially reduce some of the capital gain depending on your scenario through contributions to super, and then it's a matter the tricky part of that scenario, and obviously this is just general advice because I don't know your full circumstances, but the tricky part to your scenario is how much you can get into your super fund each year. So there's and depending on what the value of the property is, so there's the $150,000 limit each year. So if both you and your wife satisfy the work test, then you can get $150,000 in, plus another $50,000 of deductible contribution. So that's like $400,000. But how soon you do it depends on how much or what the value of those properties are and how long you expect to continue to satisfy the work test. So really it just gets down to how the amount of money that you've got in assets that you want to get into super versus the contribution limits and the time frame up until 75. They're kind of factors on how quickly you do it. Does that answer your question?
Yes, I guess it does largely, and I think the money from the unit would come within the framework that you're talking about. I guess the unknown, imponderable one is as to how long is property going to be better than shares, and I guess that's anybody's guess.
Yeah, exactly right. If you've got the flexibility to wait until just before 75, and it really gets and you're able to get all the money into the super fund, then it really gets down to the comparison between property and your investments within, in this example, I guess, Christian Super. And that's just something that we haven't got a crystal ball on. Property prices have done so well for so long, and you get the likes of the economists saying that we're the most expensive country in terms of property. But I think they compared it to against rents to property values. So some people question that as a way of analysing that. But regardless of how you look at it, property prices are very expensive in Australia. But at the same time, we have net undersupply as well. So it's you can't predict which one's going to go. The only thing you can do, I guess, is try and maintain a diversified portfolio. So if you've got some in the likes of other investments and some within property, it can work well. But yeah, as to the timing of what you're trying to do. Yeah. Oh, my pleasure. Did you have a follow-up question?
No. That answers the questions.
Yeah. Oh, my pleasure. Thanks for the call, and thanks for doing it via voice. It was a nice change.
Okay, you're welcome.
Okay, bye-bye. Yeah, so thanks, Jim, for that question. Feel free to continue to email through your questions, or if you put your hand up like Jim did, I'll unmute your line and you can do it verbally. Just one from Rachel there. Regarding binding beneficiaries, can super be paid into a family trust or death of a member? Yeah, one of the scenarios with that we generally encourage people that have got minors, so people that I think under 18, we, as financial advisors, we often encourage them to think about setting up in their will, making the provision to set up what they call a testamentary trust. And what that means is that in this scenario, you would set your beneficiary up within your super fund as your estate, So on your death, you might have some insurances paid into your super, and then your super balance plus those insurances would then be paid to your estate, and then your estate would distribute them to, for the benefit of potentially these minors. It could be put into, via your will, a testamentary trust for your children. And if they're financial dependents, then you won't pay the tax on the way through. And additionally, if it's set up as a testamentary trust, these minors can get access to adult tax rates. So the $6,000 tax-free, and then 15% between $6,000 and $37,000. Otherwise, if they're minors, they end up paying tax at the child tax rates, which are, I think, is about $3,000. I can't remember the exact figure. It's just gone up. But about $3,000 is what kids can receive tax-free. And then after that, they pay something like 66% in tax. So, very good question, Rachel. Setting up a testamentary trust within your will that super fund money can be directed to works well.